So, all right, let me go into the assets. What kind of assets do we have here? Notice the categorization. We've got the current assets and then bank accounts, the accounts receivable, and the other current assets. Notice you might be asking, where do they come up with these categories as opposed to if I went to the full balance sheet under assets, let's just do it this way, where we have current assets and then all this stuff in current assets and then fixed assets, right? So over here on the condensed, we have the current assets and then the fixed assets, and under current assets, bank accounts, accounts receivable, other current assets, and then our fixed assets. Whereas in the extended version, we have the current assets here and then all of this detail within the current assets, and then the fixed assets, all of the detail in the fixed assets. So to understand how the system is doing that, let's go back to the first tab, and I'm going to go into the sales on the left-hand side, and let's go into our transactions, and then let's go into our chart of accounts. Into the chart of accounts, I'm going to close up the ham boogie up top, and you can see we'll talk more about the chart of accounts when we start a new company file and we set up the chart of accounts from scratch. But you can see at this point in time that it's organized by the account type. So every time we set up a new account, we're going to give it an account type. The account type can be thought of as assets, liabilities, equity, income, and expense, balance sheet on top of the income statement, but further broken down into the bank account, which has a specialty component because the bank account could be connected to the bank feeds, and therefore QuickBooks needs to identify it differently in order to give it that functionality. Accounts receivable is a current asset, but it has a specialty component because it needs to tie out to the subledger related to who owes us money, the customers. And then the inventory, which is going to be where the other current assets start, even though it has a subledger as well, but there's less connection with it. And then all of the other current assets. So you can see what is the summary thing doing over here. It's taking these account types as the summarization factors. It's summarizing them by account types is the general idea. So that's, you can just get an idea of how this is being constructed, how the summarized item is being constructed. If I went to the full balance sheet, you could still kind of get to the summary. How? Because you see these little triangles. This triangle represents assets, liabilities, and equity. And then this sub-triangle represents another normal category within the balance sheet of current assets. And then these triangles represent the account types. So bank account type has a specialty component because it could connect to the bank feeds. Accounts receivable has a specialty component. So even though there's only one account within it, it still has its own kind of triangle. And then the other current assets are all the other current assets that don't have a special need, like connecting to the bank or having the subledger for accounts receivable. And then you've got the fixed assets, which have a special component because those are going to be the property, plant, and equipment that are going to need the subledger of accumulated depreciation. And then within the liabilities, you have, once again, total liabilities here, which is a normal subcategory, current liabilities, which is going to be a normal subcategory for a balance sheet, and then we have the categorizations of the account types. That's what these triangles are. Accounts payable having a special need for vendors, subledger. Credit cards are like bank accounts, right? Because they can connect to the bank feed, so they have a special need. And then all other current liabilities that don't have a special need are under this triangle. And then these are the long-term liabilities, which is a normal categorization. And then under equity, these are all the triangle for the equity type of accounts. And we have the different components within the equity. So let's now open these up like one by one and just kind of go through them in a little bit more detail here. So we've been working now in the assets and in the current assets. So let's just close this up to the assets. So within the current assets represent assets that are going to be consumed. You could say usually basically within a year is the general idea. And the first current asset is usually, in normal parlance in a balance sheet, the cash and cash equivalents. But in QuickBooks, they use a little bit different terminology. Why? Because we have to list out the checking account being different than basically all other cash equivalent type of accounts, because they have, again, that special need of being able to connect to the bank feeds. So now we've got this term that's not really normal on like a normal balance sheet of the bank accounts, where we have the checking account and the savings accounts. Now, you might be able to change some of these terminologies if you wanted to use this for external reporting purposes, in which case you might want one line item for cash and cash equivalents. But that's that. Now, notice what's also not under this categorization is the clearing account for undeposited funds. So if you are collecting at a register, or you're using credit cards and you're putting them through undeposited funds so that you can then deposit them into the checking account, then the undeposited funds isn't going to be under the banking, even though you would think it would be a cash type of account, and is a cash type of account, because it doesn't need a special subledger. Therefore, it's going to be under the other current assets, undeposited funds. That means when you're kind of grouping your cash together, if you have items in undeposited funds, you have to include that in cash and cash equivalents. For example, if you're tying this out to the statement of cash flows for the cash equivalents, you're going to need to pull in that number, which can be a little bit confusing. Hopefully, the undeposited funds will typically be cleared out as you have cleared them out to zero, as it is a clearing account. All right, and so then we've got the accounts receivable. So note that the accounts receivable would only be used if you're in an industry where you have to do the work first and then invoice the client, in which case you have to track the outstanding receivables, and that means you're going to have the accounts receivable, which will have a subledger breaking out the receivables by customer, which we will typically track internally by going to the first tab, Ham Boogie, and the sales tab. And we've got our customers over here, right? So we could track the customers that have outstanding balances within them. So notice from a reporting standpoint, this is kind of ugly because you don't typically have more than one accounts receivable account. So to have a sub account and the accounts receivable is kind of ugly. But you can see why that would happen functionality wise within QuickBooks, because they're giving a separate triangle for every account type. And accounts receivable needs its own account type because it has a special need to track the subledger for the accounts receivable by customer. Now, this might be, if you add another account, say, which is allowance for doubtful accounts, for example, to estimate the receivables not collectible, this dropdown might make more sense if you can group that allowance account in the same category, but we won't get into that right now. And then the other current assets, this is where all the other current assets would be if they don't have a special need. So remember, normal bookkeeping or normal financial statements would not have a special breakout for the banks or a special category for accounts receivable. They would just be listed under current assets. They have a special breakout because of the functionality needs being different account types within QuickBooks. And then all the ones that don't have a special need are under just the other current assets, including inventory, noting inventory does have a subledger need, but the subledger isn't tied exactly, even if you're using a perpetual inventory system, to the account as it is with accounts receivable. In other words, QuickBooks' subledger for accounts receivable is forced basically to tie in to this account, because every time you post something to accounts receivable, it forces you to add a customer. It doesn't do that with inventory. Inventory has an inventory subledger, which should tie out here, tracking inventory by unit as well as dollar amount if you're using a perpetual inventory system. But QuickBooks will allow you to post to the inventory account without entering an item, which means that if you do that, your subledger will not match what's on your balance sheet, which will cause you a problem. Now, QuickBooks does that, of course, because you might not be using a perpetual inventory system. You might be using a periodic inventory system, in which case it would make sense to post something to inventory without hitting the subledger. We'll talk more about that later. Then you've got your undeposited funds. That's that clearing account that really should be up in the cash and cash equivalent area, but will go to zero after we clear it out, after we make the deposit. So we'll talk more about that as we go later. Then we've got the fixed assets. These are the long-term type of assets. Now, notice that all of your assets, you can kind of think of them as investments. And this term investments is a little bit confusing because if you hear the term investment, you're usually thinking stocks and bonds, most likely, because that's where we invest things for retirement and try to gain or generate income on it and whatnot. But note that everything on the balance sheet is basically an investment because we're investing in the asset to help us to generate revenue. So in other words, if we had cash, we could basically invest the cash in the business. We can buy like expenses, in which case we would have consumed it. If I pay for the utility bill, I have consumed something in the service of helping me to generate revenue. But if I buy something like a truck, then I haven't consumed the truck yet. I bought something to be used in the business for the objective of generating revenue, and therefore it's a type of investment, right? And so even putting my money into the business account instead of my personal account is really kind of a type of investment, because the idea would be I have the money in the business in order to buy something in the future that's going to be used in the business, either expenses, paying the utility bill, telephone bill, or paying for fixed assets like the truck in order to help me generate revenue in the future, right? So that means that these down here are fixed assets, long-term assets, things that we couldn't expense because we have not yet consumed them, therefore are forced to do the accrual thing, putting them on the books as an asset, even if we're on a cash-based system for like taxes, because the tax code will force us to still put it on the books as an asset. And the most common and clear example of that would be, for example, if you bought a building for like $100,000 cash, most of us still wouldn't think, well, we should just make a building expense for the $100,000. Why? Because no, that doesn't make sense, because we bought the building, it should be an asset. So that kind of makes sense. But if we were on a cash-based system, we wouldn't. We would just expense the $100,000. So that's just an example. The trucks, the automobiles, the property, plant, and equipment all have a similar functionality. We are going to have a subledger with them, but oftentimes, particularly in the United States, we don't track that subledger within QuickBooks because we're going to need to track it for income tax reporting purposes anyways, meaning we're going to have to track it in tax software according to the tax code, at the least, the tax code being different than often generally accepted accounting principle codes or accrual concept codes, but we need to do that in order to be in compliance with the tax code. And if we already have the subledger, which will be a complex subledger in the tax code, in the tax software, we might as well also use that for our bookkeeping subledger. Otherwise, we're going to have two subledgers that are going to be quite complex that we'll have to reconcile all the time. So that's why oftentimes we will have a subledger that won't be in here, but we need to make sure that we track it closely in the subledger that might be generated from tax software.